This conference will now be recorded.
Yesterday, we just gone through the content. Today, let's go through one consolidation scenario. Most of you are from FSU, basically you have accounting background or BPC or BOFC. So in group reporting, you might be having something in your mind like what we can achieve using this particular group reporting. Actually, first I planned for the system demo. Later, I changed my mind. I will give you one example what we can do it in group reporting in an Excel. So I will take it in one Excel example. We will take some trial balances and we will consolidate those trial balances uh, as per as per system understandable format. If I use a system, if I use a group reporting system, how it is going to generate that consolidated financial statements so that you also understand what is consolidation. If you are new to consolidation, functionally you can understand what is consolidation and what are the different capabilities of group reporting. So let's understand that solution. So I have I prepared two trial balances. You can see this trial balances. All these are my balance sheet accounts. My balance sheet account starts with one series, and I have liabilities. My liabilities account starts with two series, and I have equity. My equity account starts with three series, and 4, 5, 6, 7 are my income and expense accounts. Income and expense accounts. So you can see the descriptions also here. And when I load the data, so load data in the sense I can collect data from different sources. I collected this data from CSV files, for example, non-SAP companies. Here, if you observe, FS item means my consolidation account, and I have partner unit here. So partner unit is basically we call it as trading partner, and here my consolidation units are here. Consolidation units are my legal entities. I have one consolidation group. So let's say consolidation group is Europe group. In this Europe group, I'm going to consolidate the Switzerland and France books basically. So you can see each and every account balance. When we consolidate, we take the balance. We will not take debit amount, credit amount, and all those things. We can consider there is something called a transaction type for balance sheet accounts. Functional area for P&L accounts we can consider. For this example, I want to make it simple, so I have not considered uh, those transaction types like opening balances, movements, and all those. Let's execute consolidation for these two consolidation units. So Switzerland is the holding company in this particular group. Switzerland is called as holding company. Why holding company? Switzerland invested in France. Switzerland invested in France. So Switzerland is the holding company and France is the subsidiary. Why I call it as subsidiary? Because Switzerland owns 75% of France. France is called a subsidiary. So Switzerland investment in France is something around 75%. 75%. So when you follow some accounting standards, right, when you consolidate, you have to follow some process. What is that process? All the trial balances, all the TB or balance sheet or income statements, you should have in one currency. So that's called group currency. So in my case, when I get the data, I can get the data, I can collect this data from different currencies. However, I need to convert all those local currencies into group currency. Here my group currency is euro. So my consolidated currency is euro. So amount in group currency, the group currency is euro, for example. Also, for a for these two consolidation units, you need one common fiscal year variant. I mean, period maintenance should be same, right? So period maintenance. So I'm saying like January to December, right? Calendar year I'm following. So one common period maintenance should be there. One common fiscal year variant should be there in FICO language. Now here, if you observe this particular data, these are my trade receivables. 12100, which is my trade receivables account. If you read this particular data for the Switzerland, this is the consolidation unit, right? So 24,750 euros is the third party transaction. How can I say this is third party transaction? Because there is no partner unit here. Hash means blank, blank means initial. When there is no partner unit, that amount is called as third party transaction for that account receivables. If you see for the France, this is the consolidation unit, third party transactions are 24,750. Yeah, this is how I have to interpret the data. And also if you see Switzerland account receivables from France, right? So is 2,100. Switzerland's account receivable, that means 2,100 euros intercompany transaction. And here also France account receivables from Switzerland is 1,020 euros. So basically, these are the intercompany transactions. Intercompany transactions are identified with the trading partner. This is how the data available in the Universal Journal itself. Universal Journal means ACT document table or any CSV files when I collect non-SAP data. So I need to collect third-party transactions, intercompany transactions. Same way you can observe here accounts payable here. So if this accounts payable, if you see that the trade payable, right? Switzerland's payable to the France 918 euros. France payable to the Switzerland 2,105 euros. Right. So what happens? And you can see what is this? See, Switzerland investment in France is 75%. So the what is the value? This is the percentage. Now there is an account 172100, which is called investments in subsidiaries. So the investment in subsidiaries something around. So Switzerland invested in France. France is the partner unit. So 150,000 euros, 150,000 euros. Switzerland investment in France. And if you see the issued capital of Switzerland is 218,000 thousand euros, something around 218,090 euros. And France equity common issued capital is 68,090. Also, Switzerland's retained earnings you can see 41,640. France retained earnings something around 41,640. And also, if you see this P&L accounts, so for example, I have sales account. Even sales also, I have some intercompany sales. Intercompany sales to the Switzerland intercompany sales to the France minus 12,000, and France intercompany sales to the Switzerland with the Switzerland it is something around 13,000. 13,000, right? And also you can observe some dividends also available, right? Inter unit dividend, but it is for Canada. It is not in the within the group. So from Canada, this particular France received some dividend 9,850 euros. So now you can observe here what is the total of these sales. So sales plus these things. So just let's take like this 28,520. This is my net income. So I calculated the net income and I posted. So before consolidating, so it's not like FI. FI, what happens at the year end? You carry forward. When you carry forward, retained earnings are calculated. But consolidation, it is based on the consolidation frequency. What is consolidation frequency? In an year, how many times you want to execute the consolidation? This information you can get it from your customer. One customer says, yeah, I want to execute the consolidation every month. So that is the reporting period. So 12 times in a year they are going to execute the consolidation. Each time they execute the consolidation, they have to calculate the net income for that particular month, and they have to post. Some customers might say, I want to, my consolidation frequency is 4 times in a year. That means quarterly they are going to execute. So when they say quarterly, what we have to do, every quarter end, last period of the quarter, we are going to execute the consolidation. That means 3, 6, 9, 12. If it is half yearly, 6th month and 12 months we are going to execute. So always remember, in the reporting period, when the consolidation frequency is 3, so consolidation frequency is a quarter, last period of the quarter we are going to execute. If it is half year, last period of the half year we are going to execute. If monthly, every month we are going to execute. That's the common fundamental we use for consolidation. So here what happens? The net income is calculated. One leg is posted here in the net income account in the P&L side. Other leg is posted to the equity side. 3 series is my equity side, that 78,520. So it's adjusted your equity, and it's also posted the net income here in the P&L. So if you see the total of this P&L statement, it becomes 0, including the net income. Same thing is applicable for the this particular France and Switzerland. So let's freeze here. So now two things common: group currency euro and period maintenance January to December, 1 to 12 months, and consolidation frequencies month. So this is the period. So now I'm doing the consolidation for the period 01 to 2022. December 2022, I'm doing the consolidation. This data is taken from the CSV file. So first thing, we need to do the currency translation, right? We need to calculate the net income. So net income, we need to calculate in the local currency. Net income can be calculated in the local currency. Then we'll perform the currency translation. Local currencies are converted to the euros. If both the currencies are same, local currency and group currencies are same, then no need to perform the currency translation, because local and group currencies are same. Now, when, so remember, this investment is 75 percentage. I have to maintain this 75 percentage. So when the investment is 75%, 25% is my minority. Minority for in the, this is the external part. 25% of France external part. 75% of France is group part. That's how we interpret this particular statement. So Switzerland investment in France is 75%. So what is the value of the investment? 150,000. You can see here. Now, when if you aggregate these two trial balances, for example, here I just made made total. So total means total cash on hand, both the cash, all the trade receivables, including third party transactions and intercompany transactions. I just aggregated, right? So when I aggregate the total of these two, France and Switzerland, it becomes 0. However, this total is wrong. This is not the consolidated financial statement. This is called aggregated financial statement. Is called aggregated financial statement. So if you want this financial statement in a balance sheet or P&L format, yes, we have a capability to develop the hierarchies. We can develop the hierarchies. Already hierarchies I developed. It's there in the system. I can show you. So just for common understanding, I prepared the uh, flat structure. So this total is wrong, right? So you can, so this is called aggregated balance sheet and income statement, so which is wrong. So what we have to do first, we have to eliminate the Once the currency translation is done, there are so many activities. So some of the activities we will do. The within the group, right? So whatever intercompany transactions are there, those intercompany transactions first should be intercompany transactions should be eliminated. So we can identify the intercompany transactions. However, if you observe one point here, when you are doing the intercompany eliminations, 121100, which is account receivables, Switzerland account receivables with France, 2100. Now, France accounts payable to Switzerland should be 2100. So, Switzerland account receivables with France, 2100. Then, France accounts payable to the Switzerland should be 2100. However, if you see, France accounts payable to the Switzerland is 2105, 105 euros. So there is a difference of 5 euros. I need to identify the differences also. If you eliminate, see, 2100 against 2105, if you eliminate both these transactions, we call it as pairs, transaction pairs, right? We can match intercompany. There is an application, right? Intercompany matching and reconciliation application that can tell you there is a difference of 5 euros. But when I'm eliminating that 5 euros difference, I need to address, I need to post as a transaction difference or any other difference. So for so we need to system can identify the intercompany transactions based on the trading partner. So is in the ICMR application, we can configure so against account receivables, against accounts payable, right? So that pairing also you can perform in ICMR. So once ICMR is a separate application, now I'm not going to discuss, but based on the ICMR differences, we can post the transactions, eliminations. So let's understand how the elimination should be posted. So what we have to do, let's insert one column here, one column. So we inserted a column here. So now here I'm performing the eliminations. Eliminations I want to track with a separate column, right? So here also eliminations. So when you are eliminating, first thing what you have to do, first identify account receivables, right? So this is the transaction I want to eliminate. So France elimination, France, Switzerland is having transaction with France. How much? 2100. So that should be eliminated. So minus 2100. Yeah. I am creating the minus 2100 because Switzerland intercompany transaction with France is 2100. Same way, France intercompany transaction with Switzerland is 1020. This also I have to eliminate because trading partner is available. So minus here also minus 1020. Done. Then any other intercompany transactions? So only I'm talking about intercompany transactions. Investment in subsidiaries I don't consider as a what do you say? I don't consider it as intercompany transaction, right? It's part of consolidation of investments. We will treat this one later. So in the you have merchandise. In this merchandise trading goods, you might have inventory that also you can eliminate. We will do it later. So that also you can eliminate from different based on some one-sided elimination concept. Then so these are eliminated. 2100, 2000, 1020 eliminated. Then let's go to the trade payables side. Trade payables side. So in the trade payables side, 918. So this, if you can find Switzerland trade payables with France, 918. So that 918 I'm going to eliminate. Minus becomes plus. And also France payables to Switzerland 2,105. That also I'm going to eliminate. 2,105. This is also eliminated. So we can check all other transactions. So issued capital, right? Retained earnings. These two we use it in the, what do you say, consolidation of investments. These also we need to eliminate. We will eliminate later. Now, if you see this, if you observe, there are some transaction difference. For example, Switzerland transaction with France is 918, which is accounts payable, and France account receivable from Switzerland is 1020. There is a difference between these two transactions. I need to address that differences also. So how to address those differences? You can create some transaction differences, some accounts. Okay, transaction difference offset accounts you can create, so that it will post accordingly. So let's add some offset account here. So I'm inserting some offset accounts, some transaction difference accounts. Without this also it identifies, but let's let's do it how the system is going to perform. So here when you do the manual eliminations, it's just an entry, right? uh, uh, so that what is debit, what is credit. But when you want to use a system, so you should have a proper data set and proper data cut when you are posting the data. So here I have one account 21110C, which is called offset account, which is called offset account, intercompany offset account. So in this offset account, yeah, you can post the whatever balances are there. So for example, here 2100 918. So let's add these two, minus 2100 plus 918. So something around 1182. And also we have some other difference, this 5 difference also there. I have not posted this 5 difference, right? So the including that 5 difference, it is 1187. So there is a $5 difference is there, €5 difference is there, right? That also we need to consider. So here you have to post the offset. Yeah, offset when I'm post. So I'm offsetting this with this 5. So let's say offset with France, one transaction it will post. Switzerland, one transaction it will post. So France with Switzerland, right? Offset I'm going to post something around 1187. 1187. And so there is a difference of 5, right? So the 5 also I need to address. Let's add one more line here. So I'm creating something, one more account, which is called transaction difference. 2110 P is transaction difference. Intercompany differences differently I'm handling. So France and Switzerland. So this here €5 against France I'm going to identify. Yeah. So here €5. How this €5? 2100 here 20105. So whether you want to post this difference in the leading unit or partner unit, right? That configuration also you can handle. ICE differences can be posted to the leading unit or partner unit. Even that also I can configure with my thing. And also eliminations France side. Yeah, France intercompany transactions with Switzerland, which is minus 1187. See, both are matching. Now, whatever transaction differences are there. So, for example, here 1020918. Yeah. So there is a difference of 102. Correct, positive number. There is a difference of 102. That is basically my uh, transaction difference, for example. So here the transaction difference can be posted 102. 102 here will post. So this is the transaction difference. Here minus 5 is transaction difference, missing transactions or whatever. So this is how the intercompany transactions are handled. So now we handle the intercompany transactions. Now if you observe here, total of you see eliminations. So 1187, 1187, my offset is matching. So any difference is the offset I posted with the transaction difference. Actually, these two numbers are 1182, but my offset is 1187 total because both the books I have to match. Yeah, so this is how we have to match. Then once the intercompany eliminations are done, once the intercompany eliminations are done, you have to think about you have to think about consolidation of investments. So I just gave accounts payable and account receivable. Like this, you will have dividends elimination and IPI, profit on inventory eliminations. All those things we are going to discuss. We are going to generate the result. Now, consolidation of investments. Consolidation of investment is relevant to your investments and capital, right? Always consolidation of investments, COI, deals with your investments, investment from holding, and capital from the. These two things we will consider under part of consolidation of investment. That's why investment in subsidiaries, if you see Switzerland investment in France, I see here, but I have not eliminated. So now we will insert one more column here. One more column here. Insert. And here also I'm inserting one more column. Now you inserted one more column. Yeah. So here, this one also I'm just matching this one. So here we are going to handle the eliminations or consolidation of investments. So COI entries, COI eliminations, you can say COI eliminations, COI eliminations, COI elimination. So here what happens? There are some rules when you are performing accounting. Some accounting standard says first you have to eliminate the investments. Whatever intercompany elimination is, that is separate. Now, as part of consolidation of investments, when you want to run the consolidation of investments, there are four things you have to perform, right? What are the four things? Investment eliminations, investment elimination from the holding company, holding company. In our case, holding company is Switzerland. Capital or equity elimination, capital elimination from the subsidiary, from the subsidiary is France. How much percentage? 100%. 100% you have to. This is 100%. But there is a minority here, 25%. Then you have to calculate the minority interest. Calculate the minority. So minority is 20. So minority, I want to post it in the France only. So all these are posted in the group, right? Europe group. Against which consolidation unit you can specify. So 25% minority is to be calculated. So minority is in the sense what is external part. Not 25% is not group part because my investment Switzerland investment is 75% only. And then you have to calculate the goodwill. Goodwill, some people want to post in the subsidiary, some people want to post in the uh, uh, holding. Both are possible. Both are possible. So SAP has given that option. So now most of the customers post the goodwill in the subsidiary. So I'm just taking goodwill as uh, I'm posting the goodwill in the France books. So how much percentage? So how much is the goodwill? Goodwill is investment investment from the holding company minus 75% of capital, right? So that's what capital includes my common stock plus retained earnings, for example. So the difference between these two becomes my goodwill. So all these entries I am going to track with CYA eliminations, right? So let's understand. So here, investment in subsidiaries. Where is it? Here. Investment in subsidiaries. In this investment in subsidiaries, Switzerland invested in France. Correct? How much? 150,000. This 150,000 I want to eliminate. Correct? So eliminate, and I will post it in a separate column so that the customer can easily identify the investment eliminations. So minus 150,000 investment eliminated. 100% of common stock should be eliminated, right? And from where? From the subsidiary. From the subsidiary, 100% of common stock should be eliminated. So that I'm going to post now. So here, what is my subsidiary? France is the subsidiary. So France common stock, you can see here, common stock, issued capital, 68,090. So I will post positive 68,090. So that 100% of issued capital eliminated, and also 100% of prior year retained earnings should be eliminated. So which is 41,640. This is also eliminated. 41,640 eliminated. Then I need to calculate the minority interest. So this is, I need to calculate the minority interest, which is NCI, we call it as. So NCI should be shown separately. Yeah, we have separate accounts to show the NCI. So what is the NCI here? 68,090 multiplied by 25%, which is external part. My investment, Switzerland investment is in France is 75%, right? So 25% is minority. I have to show the minority separately. So here what I will do, I will insert one account. We can insert here itself, yeah, or we can insert here. Let's insert here. Insert one row above. Let's insert one more row. Let's insert one more row. So there is one account called, we will create NCA account separately in the consolidation chart of accounts. So 321100 NCI, you can name it as NCI equity, for example. NCI equity. So here NCI equity, how much I can, so there will not be any partner unit. So let's calculate this one. 68,090 minus 60, so minus, so equal to 68,090 multiplied by 25%, which is 17,000, also equal to 41,640 multiplied by 25%. How much both together is? Sum of these two, 27,432. This 27,432 I have to post. Correct, right? 25%, 75%, this thing. So NCI 321100, I'm going to post 27,432 minus. Yeah. So once 27,432 is posted, yeah, correct, right? So this 410, 432, correct. Now, goodwill you have to calculate. So NCI equity is calculated, and goodwill also you need to calculate. How to calculate the goodwill? Investment minus investment minus 75% of my common stock and retained earnings. So what is my investment? My investment is 150,000. Switzerland investment in France is 150,000. 150,000. 75% of my, so let's calculate 75%. Here only we will calculate. So 75% of common stock is 37,449. 75% of retained earnings is 31,230, total 68,679, right? So goodwill is your investment minus this 75% of your equity subsidy. So which is 81,320. So where I have to post this goodwill? In the goodwill account. So I have, so goodwill treatment is depends on you, right? Some, suppose some people want to go with extraordinary amortization, then first they will show that goodwill as an asset, then they will every month they will use the direct elimination. Yeah, sometimes entire amount, right, based on the accounting standard, based on positive goodwill. If it is positive goodwill, you can, so this is my positive goodwill. There are two things: positive goodwill, negative goodwill. If your investment is less than your 75% equity, that's called negative goodwill. Negative goodwill, you can do the direct write-off. Here you have to do the direct elimination. Direct elimination in the sense you can show it as a equity reserve, this 81,320 directly. So now let's say I want to show it as an asset. So I want to show this one as an asset. So what I will do here, I can insert one row here, insert one row here above, 163100. This is my goodwill account, my goodwill account. So my goodwill account, yeah, so which shows the 81,320. 81,320. So mention the 0.5 also so that it will match. So this is what called first consolidation, right? Investment eliminations, capital elimination. So this is now your consolidated financial statement is ready. You can also from the so first month, when you do the first month of consolidation, you call it as first consolidation. From the subsequent months, you are going to perform subsequent consolidation. That's called subsequent consolidation, right? So now if you observe, I have done the first consolidation, but I have not considered the, as part of first consolidation, I have not considered my current month net income. If that is the case, for the first month even I can run the subsequent consolidation. If I consider first month's net income also, that current month net income also, then no need to run the subsequent consolidation. But if I'm not considering first month consolidation, I mean first month in the first consolidation document my current year net income, then I need to run the subsequent consolidation. So let's see whether now only first consolidation I have run, and I want to check whether my documents are matching or not. Yeah. So how to match? Just let's make the totals. And if any differences are there, we need to analyze why the differences are coming, and we need to address those differences. Let's see. I'm just deleting this. Some intercompany transactions I have not eliminated knowingly because it will take a lot of it will take more time. I don't want to that we can, when we start the sessions we can discuss those. So let's sum up all this equal to
Kiran,
sum of.
can you tag the cells E1 and E2, like what the name for the on the column F
Cells E1.
and E2? Like we did some personal
Ha
calculation,
ha
like
ha,
not,
ha.
yeah,
You want
just put
some
tag.
description?
Yeah, that helps us.
Sure, sure. So these two, see, all these four columns when you add, you will get the consolidated financial statement. So now you can see. So there is a difference of 13,618. Okay, that we will see this one. So now if you see in the consolidated financial statement, yeah, consolidated financial statement, investments are eliminated, shown as 0. Your capital should be eliminated. So issued capital eliminated. So 68,090 eliminated, but you holding company's equity you have to show. That I'm showing. Same thing for the retained earnings. And net income, so we have not done the subsequent consolidation. So actually from this 78,520, I have to show the what do you say, that NCI part. I have not showed. So so that's it. So now if you see the intercompany transactions, for example, if you see the trade receivables, yeah, so trade receivables, it's 0 against France. Only third party it is showing. So these are the third party transactions, right? So let's change. Let's just reduce the column number columns. Right now you can see in this. For example, if you see the receivables, only third party relevant receivables you will see. You will not see all the receivables. So this is how we prepare the consolidated financial statement. So to configure this intercompany eliminations, we need to use some reclassification methods. To configure the consolidation of investments, you have to use some reclassification methods. You have to design your financial statement items. You have to develop some hierarchies. You have to create your consolidation units. You have to create your consolidation groups. You need to define the percentages. You need to use different document types to segregate your data. You need to create consolidated P&L statement, consolidated balance sheet, and also we discussed only consolidated balance sheet and consolidated P&L. We have not discussed cash flow, changes in equity, comprehensive income. All those reports also you have to develop as part of this group reporting product. So today, whatever we discussed, right? If you are an FSEO consultant, right, you need to go through this particular recording 1 or 2 times. Then you will get some idea. Then uh, you can understand group reporting. So if you are not able to understand today's scenario, it is entirely bouncing or something, then don't. It's all a calculation only, right? If you are not able to understand first time, second time, third time, better don't learn group reporting, right? So these are all calculations, right? Yes, there is a functionality, but if whatever if I say all are Excel calculation, if you understand this Excel calculation, yes, you can go for the group reporting. Now, so this is basically 75% of issued capital, 25% of retained earnings, right? So this is my investment. This is my goodwill. Goodwill. So goodwill is investment minus this 75% of common stock. Yeah. So this is all about group reporting. This is what we are going to perform consolidation. So I explained only first consolidation. So because I'm going to handle in this particular group reporting batch, I'm going to handle first consolidation and subsequent consolidation. And reporting side also we are going to understand. We are going to understand cash flow calculations and all those things. And other than this, on top of this, advanced consolidation of investments are there, which is a separate course I have. In that, I'm going to handle how the investment increases if the investment is increased 75% to 85%. What you have to do. If the capital is increased from the subsidiary, what you have to do. If one particular consolidation unit is divested from the group, how to post the transactions. If some partial divestiture happened, how to handle. If accounting method change happened, how to handle. If merger happened, how to handle. So that is a separate. That is full functionality based on functionality product. I mean, it's based on the consolidation functionality. Those are called activities, consolidation activities. So that's where SAP come up with activity-based consolidation of investment. So that is separate. So in this, whatever I performed here, this is what we are going to perform using the group reporting. All the configurations, currency translation, net income calculations, data collections, topside adjustments, all those things we are going to understand as part of this particular course. Yeah. Any questions?
This one question over here. So this is a great example, like where you're showing. So as we go through this detailed course, so you mentioned group currency, but then what is the local currency over here? So this column D where you started the conversation, column D and column G is where we started. So which is the local currency over here, or this
I have
because
not
group
showed local currency itself. By default, I took the group currency values only.
I see. Okay, okay. So as you go through the course, then you will insert one column called as a local currency.
Correct. So
I
you
see.
will
Okay,
you will
thank
get
you.
the local currency.
Okay, thank you. I appreciate it.
Right. You yeah. So if you are interested, so from next weekend we will start the course. Right. I will tell you how to implement the product, this particular group reporting. What you have to first, I will start with how to implement. That means what are the SAP nodes you have to go through, how to enable the content, how to implement, how to add the roles and all those things. Then we will understand the product. At the end, you will understand this particular total scenario, group reporting scenario. If you are interested, if you want to join the course, just send an email to me. I will update you. I will send you all the details. Uh, I mean, which account you have to pay, all those details. I will send it to you. Yeah. Any questions now? Any other questions?
Then
Hi,
what is
Kiran.
the,
Yeah.
sorry, go ahead. What is the
So
first
yeah, go ahead, go ahead.
consolidation and second? What is the first and subsequent? I didn't get that. What does that mean?
So when you start the consolidation, when you do the consolidation, right, there is one-time posting. When you for example, you are using group reporting, using the group reporting product. First time you are consolidating. At that time, you will calculate goodwill and minorities one time only. That's called first
Yeah.
consolidation. Okay, from the next period onwards, what we will do every month from the subsidiary, because my subsidiary's income 75% belongs to me as a holding company. Only that 75% you will post as part of subsequent consolidation. No need to post first consolidation every month. First consolidation. First consolidation document, when you start the consolidation, first time it will be posted. NCI and goodwill
Okay.
with the
So
income.
going forward, they won't do that. That entry won't be there, or it's based
Correct.
on that.
That entry won't be there. If any changes to the investment percentages, minorities or
Okay.
capital, at that time, this first consolidation document will be adjusted.
Okay. Thank you. And the second question is, are you going to share at least this recording?
Actually, this yesterday I recorded. I don't know. Somehow it's not recorded. If it is recorded, today also I recorded. Definitely, I will share. I will share if recorded. Definitely, I will share.
Appreciate it. Yeah. Thank you. Because once we understand this functionality, then I mean, it would be easier. We don't need other recording, right, to get this concept.
Correct.
Thank you.
Correct. Correct. That,
I think it's still
right.
recording, Kiran. If you see on the top.
Yeah. Yeah. Yesterday also I recorded, but somehow it's some technical issue. Yeah. So any other questions? If you can also write to the in the chat box if you have any questions. Right. So
Hi,
I'm
Ken.
I'm yeah.
One question from my side. So
Sure.
analytical cloud, right? So that is what I understood is you are not covering that one in these 30 hours, right? So will you be
So
covering
you're
that one in
talking
the advanced group
what
currency
you're
session?
talking about. So you are talking about
Analytical
analytics, like
cloud. Analytical cloud. Yeah.
SAC is a separate course itself. SAC is a very big product. It has SAC analytics, one product, one side, SAC planning one side, SAC predictive one side, SAC analytics designer for the custom application, that is one side. Yeah, so there are four parts of that. So that
So
way
will
I
you be
cover
teaching
separate.
that one as well? Will you be teaching that
Yeah,
one
yeah,
as well?
yeah. That I start from next week.
Okay. And one more question. ICMR. So will you be covering this topic as well in this 30 hours?
Yeah, ICMR also I'm covering in this 30 hours. So I said 30 hours, it will take more than 30 hours.
Okay. Okay. Fine.
ICMR is part of the course, yes, as an application.
So it is good to learn parallelly this analytical cloud, or once we finish this at least basic level course. Okay. After that, better to join the analytical course. Which one is? What
Both
is
are
your
two
suggestion?
different courses. Both are two different courses. No relationship, right? Only for the reporting, group reporting reports, you can get it in SSC, and SSC is an entirely separate product. It's all about your time. How much time? See,
Okay.
if you want to understand group reporting, if my session in the weekend 4 hours or 5 hours, it will take 1 week to practice that,
Okay.
to get the hands on.
Yeah, Kiran,
If you have
which means,
time, then
yeah, which means
yeah,
Kiran, this is Radhakrishnan. Just a small question, like this, you are covering disclosure management and the other one also,
no,
data collection also.
GRD, GRDC I'm not going to
Yeah.
cover. Disclosure
Okay, okay,
management also I'm not going to cover.
okay. And when implementing this group reporting, is it mandatory to have the ICMR also together implemented, or how it is?
Optional.
Sorry,
It's optional.
is it mandatory?
ICMR is always optional. It's a
Optional.
separate
Okay,
application.
okay.
Yeah,
Okay. In that case, like these eliminations, how intercompany eliminations will not be taken care in the consolidation level, right?
correct. So if you are not integrating, if you don't have ICMR, then you will not see these differences. So now I handle the differences separately, right? I posted intercompany differences. If ICMR is not there, then you can't calculate this. It should be done manually. Now, what happened with ICMR and intercompany elimination? I'm going to integrate these two. I'm going to create some posting rules. Based on the posting rules, system automatically posts this 102 and 5, right? If you don't have ICMR, then your intercompany offset account, whatever is there, it will show some difference. That's a difference should be posted manually. I mean,
Okay.
handled
Oh,
manually
okay, okay. Handle manually in the group reporting itself, right?
in the group. Correct, correct,
Okay, 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 okay. And if the group, I mean, disclosure management also is not used or implemented, then manually they have to send the consolidated financial statement to a separate disclosure
correct.
system and do it manually, right? Or
Exactly, correct,
Excel or something like that. Okay, okay,
correct.
okay. Fine, 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 fine. Thank you, thank you, thank you.
So, Kiran,
Right.
are you going to
So,
share this Excel sheet and video recording both?
sure, sure. Just send an email, please.
Yeah, sure. Yeah, I already
okay.
enrolled for this, so that's why uh,
Okay, done.
yeah.
Kiran, I
So
have one
you,
question. During the course, do we get the session recorded after the every session? Because while we are practicing, it will be helpful to us to the
I'll make
video.
sure that your practice will. I will as per the manual. So there is a
Okay.
training manual. So configuration steps. Each and every step, right?
Okay.
You can find it there. So there will not be any problem to practice. That I will make sure.
How do
I
we
mean,
make payment?
to recorded sessions for that.
So I will not
Is there
record the
any?
sessions. Only first session I record. Other sessions I don't record. So payment, you just send an email to me, right? That you are interested. I will send the details to you.
Okay, thank you.
Yeah. So I'm just stopping the recording. Again, you can ask me the questions. Not a problem. I'm just stopping the recording.